Hello and welcome to EduFund. Today we have a very special guest with us, Smita Shetty, who is a fund manager with Tata Asset Management. She brings along 16 years of experience and joined Tata in March 2017 as a research analyst. Previously, she has worked with Kotak Securities, HDFC Securities, Asian Broking Securities, and Dalal & Broacha Stockbroking. Qualification-wise, Smita holds a CFA charter from CFA Institute US and a bachelor's in economics. Welcome to the show, Smita.
Yeah, hi Neeraj.
Hi.
Good to have you back.
Same here. So let's talk about the index fund, which is being recently launched by Tata Mutual Fund. So we will understand about the Tata Nifty Small and Mid Cap Healthcare Index Funds first, and then we'll move to the sector.
Sure. So, Neeraj, this fund was basically, thought because of the idea that we have a lot of these mid and small cap names in the sector within both pharma as well as healthcare, which probably hold a lot of potential in terms of growth and the runway we see going ahead given where India is currently. And we thought that, this product can actually provide a good platform for investors to participate in the theme of healthcare and pharma both. This fund particularly focuses only on mid and small names because of two reasons, right? One is that it allows us to provide a unique proposition to the investors by having only mid and small names here, whereas other probably peer funds or active funds might have a larger proportion of large caps as well. So that was the one reason. Second was obviously because of high growth, right? Because we all know that whatever sector, be it mid and small, usually will end up having a faster growth in most of the cases. So that was the idea that we thought that, let us actually provide a platform for these kind of opportunities to play, particularly in the mid and small cap space.
How do you see the overall healthcare industry, grow in India over the next 7 to 10 years period? Because as you rightly mentioned, mid and small cap definitely provide the growth. But what is the future outlook for healthcare sector, particularly after COVID?
So I think, COVID definitely gave in a lot of push. I think we as Indians, or probably even globally, a lot of population became more aware of their health, started taking regular checkups, etc. more seriously versus in the pre-COVID era. We all also latched on to a lot of supplements, at least during that phase. We may not have it regularly now, but we realize the importance of that. So it clearly gotten a lot of focus on how we see our health and how we want to see ourselves in terms of our healthy lives going ahead in the
lot
future.
More focus on preventive health.
Absolutely. So preventive came to the forefront, which was obviously there in our minds at some point in time, but it became a more forefront thing to think about how we perceive preventive.
When you compare healthcare spends at a economy level, that's India is very low, below the global average probably.
Yeah.
We are nowhere closer to the developed economies. So what is your take on that in terms of the next 15 to 20 years outlook on that?
So you're absolutely right. So we spend just about 3.5% of our GDP on healthcare. The global average sits at around 9.5-10%. Obviously US you have at the higher end of 16. So I think we are pretty low, and government has also realized it, and hence we've had schemes like Ayushman Bharat, etc. Which kind of tries to increase the ambit of population under the health insurance policies. So I think we are making those steps, and gradually and slowly I think we will see an increase. And that in turn kind of turns out to be a very positive thing for these companies, right? Whoever are here in the healthcare or the pharma space. So I think runway for growth really looks interesting for multiple years to come.
Indian market currently for pharma particularly is very dependent on the global economy because of the cheaper manufacturing, and we all know that it's highly regulated industry. So do you see a challenge in the mid and the smaller size players to comply with the norms?
So I think this has been a challenge, whether it be large cap, mid or small, because you have to have a compliance, and FDA obviously tries to ensure that there is a regular 3-4 year gap. At every 3-4 year gap, they will intend to come and actually see your facilities. So I think that's a challenge, and it's an event-based risk, which whether it be large, small or mid, you will be grappling with these issues. And I think with time, companies have learned it a harder way to improvise, hire right kind of consultants and keep upgrading their facilities. So I think we are improvising, but it's not that it's only Indian companies are facing these issues. Globally also, if you look at whatever country we look at, even China, even within US, you will have these kind of FDA related compliance issues getting flagged. In fact, to the fact that India has almost 600 plus FDA approved plants, US will have close to 850 to 900 plants, right? So outside US, it's only us which are running at such high FDA approved plants. And this is despite the kind of events that we have seen getting flagged at certain larger companies, etc. So I think that this shows that how well are we on compliance. Yes, there will be these events and one can never kind of, completely ignore them.
When you speak about healthcare, healthcare has multiple segments. We have diagnostics, we have hospitals, we have, pharma manufacturing companies. So how do you see the growth in the hospital segment? Because they have always been very capital intensive. So are these companies moving more to a asset-light model, and are this trend very similar in the small and the mid-cap space also?
Yeah, so I think if you look at these hospital companies, you would have seen them say, a 7-8 year or a decade back. These companies would plan large capexes, add about 50-60% of their existing beds as capex additions, and that will kind of keep diluting their consolidated margins and PAT, etc. Because you will have to bear losses of those huge new additions of bed which come in, right? It takes about 2.5-3 years to kind of reach a decent break-even or say a decent margin level. So I think that has been changing over the last 5-7 years that I see. Companies have become more ROC focused. Companies which were struggling to make even a mid-teen or a low-teen kind of returns are now inching higher towards 20 plus kind of number. And that has changed because of the approach. One is that the number of bed additions to their overall pie is slightly coming down because of the size expanding. Second is that the asset-light model that you spoke about. Companies have realized that, even going without the land cost or the building cost, sometimes collaborating with certain companies, etc., is really working well for them and allowing them to expand in multiple regions which they would have otherwise faced challenge in terms of capacity constraints or capex requirements. So I think all of that is really playing out very, very well. And hence you will see that these hospital companies have also kind of seen multiples getting re-rated. Companies which were available at about 12-13 times EV/EBITDA, now you would see trading between 20 to 25%, 20 to 25 times EV/EBITDA. So I think increasing ROC and the increasing multiples both are reflection of what we are discussing here in terms of going asset light and having more focus on returns and margins.
Let's talk a little bit about the portfolio for a retail investor, and this fund is specifically a sector-driven fund, which is always considered to be a little riskier. However, pharma is a very defensive sector. So how do you see a retail investor should play this fund, particularly since it's a passive investment fund?
Okay, so I think pharma is perceived as defensive. I would say pharma and healthcare, but I would like to have a caveat here, because the domestic consumption of medicines that you and I have, that's obviously more defensive in nature. The healthcare spends that we do on hospitals, diagnostic, etc., is again a defensive segment. But the export, especially going to the US and the other countries, that actually has some volatility included in it. So that part of the business may not necessarily be called as defensive, but yes, as a holistic level, you can classify this sector as a defensive sector. I think as far as the exposure or the risk is concerned, see, sectoral funds, whether it be healthcare, pharma, or any other sector, they come along with their sector cyclicals or whatever challenges that particular sector might face. So investors have definitely realized, and we've seen that over the period of time, that allocation here has to be limited. One cannot go overboard with higher allocations in a particular sector fund, and that has to be in sync with your risk profile. So that, I think, is something very, very crucial to remember when investors are looking at funds.
And a longer term horizon also.
Of course, the long term horizon goes without saying. I mean, any equity exposure, whether it be sectoral or diversified, you have to have a longer 3 to 5 year horizon at least, I would say.
That's all, Meeta, from our side. Thanks a lot for your time and valuable insights. I hope our viewers would have taken some interesting insights about the new fund launch.
Thank you so much. Thanks. Yeah.
Ladies and gentlemen, that's Meeta Shetty, fund manager from Tata Asset Management. I hope you like our content. For more such interesting videos, subscribe and follow our channel.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.